I am Jesse Livermore, the man they called the Boy Plunger. I earned that nickname by making and losing several fortunes before I turned 30. What I'm about to teach you isn't theoretical. It's the hard-won wisdom that allowed me to extract millions from the market when others were ruined. This isn't just my story. It's a blueprint for survival in the most unforgiving battlefield known to man, the stock market. I began my trading career at age 14 in bucket shops, gambling dens disguised as brokerage houses. I quit school to work as a quotation board boy, earning $5 weekly. But I quickly realized I had a gift. I could memorize price patterns, sense market direction, and anticipate movements before they happen. By 15, I'd saved $1,000 from my trading, equivalent to a year's salary for most men at that time. The bucket shop owners eventually banned me because I won too consistently. They called me the Boy Plunger because I would plunge into positions with absolute conviction when I saw opportunity. I never hesitated. When my analysis told me to act, I acted with my full capital. Half measures produce half results. Remember that. My first major success came when I was just 22. I shorted Union Pacific with everything I had, sensing weakness no one else saw. When San Francisco was destroyed by the 1906 earthquake, the market collapsed, and I made $250,000 overnight, about $7 million in today's money. I didn't cause the earthquake, but I positioned myself to profit from unforeseen disaster. That's not luck. It's preparation meeting opportunity. My trading methodology was simple but required iron discipline. I watched the tape, the price action itself, rather than listening to tips, news, or opinions. The market tells you everything you need to know if you learn to listen. When I saw stocks making new highs, I bought them. When they made new lows, I sold them. I never argued with the tape. The market is always right. I developed what I called pivotal points, price levels where the entire market character changed. I would probe the market with small positions, and if they worked, I would add aggressively. If wrong, I cut losses immediately. I never averaged down on losing positions. That's the amateur's fatal mistake. When I was wrong, I admitted it instantly and closed the trade. Patience was my greatest weapon. I made my largest profits by sitting, not trading. In 1907, I sensed a financial panic coming. I established my short positions, then waited. For months, I did nothing but hold those positions while the market initially went against me. When the crash finally came in October 1907, I made $1 million in a single day, nearly $30 million today. Remember this. The market doesn't reward activity. It rewards correct judgment. Most traders destroy themselves with overtrading. I made my millions by making a few big, correctly timed trades per year, not hundreds of small ones. The secret isn't frequency, but conviction and size when conditions are perfect. My rise to fame wasn't about complicated systems or insider information. It was about patience, observation, and the courage to act decisively when opportunity presented itself. Master these principles, and you'll separate yourself from the amateurs who consistently donate their money to professionals like me. I am Jesse Livermore, and I've spent my life reading the market's language, the ticker tape. Most traders see just numbers, but I see patterns, whispers, and warnings that have made me millions. The tape tells a story if you know how to listen, and today I'll teach you my secret language, the same one that allowed me to predict the 1929 crash and walk away with $100 million. When I started as a quotation board boy in Boston at 14, I didn't understand what those numbers meant, but I began recording price movements in my little notebook, studying them religiously every night. I noticed something that changed everything. Prices move in repeating patterns that tell you exactly what big money is doing. Here's my first principle. The tape never lies. Opinions lie, newspapers lie, tips lie. But the market action itself, pure and undistorted, always tells the truth. I've made my fortune by ignoring what people say and focusing exclusively on what the market does. I developed a system of pivot points, critical price levels where the market reveals its true intentions. When a stock tests a previous high 3 times and breaks through on the 4th attempt, I don't hesitate. I buy immediately and add to my position as it rises. This isn't gambling. It's recognizing the language of accumulation. In 1907, I saw Union Pacific repeatedly testing resistance at $160. Most investors were afraid after the recent panic, but the tape told me someone was quietly accumulating. When it finally broke through, I went all in. The stock shot to 219, and I walked away with a fortune while others were still paralyzed by fear. My second principle, volume precedes price. I always watch trading volume before making major decisions. When I see unusual volume without significant price movement, I know something important is happening beneath the surface. In 1929, I noticed blue-chip stocks trading massive volume while barely moving up. Classic distribution. The big players were quietly selling to the public. That's when I began my short positions. Let me teach you to recognize distribution patterns. First, watch for declining volume on rallies and increase in volume on declines. Second, look for narrowing price ranges with high volume, the sign of a battle that sellers are winning. Third, observe failed rallies that can't reach previous highs. When I see these 3 patterns together, I know the market is speaking clearly. Smart money is leaving. The most important skill I've developed is patience. I don't trade constantly. I wait for the tape to confirm my thesis. In 1923, I watched RCA for 8 months before making my move. The stock had been consolidating between $80 and $95. Most traders got bored and left, but I saw the volume patterns changing. When it finally broke $95 with triple the average volume, I bought heavily. Within 6 months, I'd quintupled my investment. Remember this, the market moves in waves, not straight lines. I look for the primary trend, then play the secondary reactions. When a strong uptrend has a pullback on light volume, that's not weakness, it's opportunity. I made millions by adding to positions during these natural breathing periods of strong markets. The tape speaks a language of money. I've spent my life learning to hear it clearly. Master this language, and you'll never need tips, opinions, or market gurus again. The truth is right there in front of you, telling you exactly what to do. I am Jesse Livermore, and I foresaw the 1907 market crash months before it happened. What I'm about to teach you isn't just history. It's a pattern recognition framework that made me millions when others lost everything. This isn't theory or hindsight. It's the exact methodology I used to short the market and walk away with over $1 million when panic seized Wall Street. In early 1907, I noticed something most traders miss completely. The market was giving clear warning signals that a liquidity crisis was brewing. I observed how Union Pacific would rally while other stocks lagged. A classic divergence pattern that I've learned signals major trouble. When market leaders begin moving independently from the broader market, I pay extremely close attention. My strategy was simple but required immense discipline. I tracked the relationship between money rates and stock behavior. When I saw interest rates climbing while stock valuations remained stretched, I began building my short positions methodically. I never rushed. I added to my positions gradually as each confirmation signal appeared. By March 1907, I had established substantial short positions, particularly in copper stocks. I recognized that the banking system was overextended, with too much speculation built on too little actual capital. When I saw Knickerbocker Trust Company's balance sheet, I knew the house of cards would collapse. The key indicators I monitored daily were divergence between market leaders and the broader index 2, rising interest rates alongside continued speculation 3, deteriorating breadth, fewer stocks participating in rallies 4, copper prices weakening while production remained high. When the crash finally came in October, I was fully positioned. While Otto Heinz's failed corner of United Copper triggered the panic, I had already anticipated the structural weakness. As Knickerbocker Trust collapsed and contagion spread, my positions multiplied in value. I didn't need to do anything but watch. What separates my approach from others is patience and position sizing. I never risk more than 10% of my capital on this thesis, despite my conviction. I've learned through painful losses that conviction must be tempered with risk management. Even when I'm certain, I size positions to survive being wrong. The most valuable lesson from 1907 wasn't just identifying the crash. It was having the emotional fortitude to hold my positions when everyone around me panicked. When F.A. Heinz's brokerage failed and the panic accelerated, I didn't cover early. I waited until J.P. Morgan began organizing the bailout before I started covering my shorts. I've developed a sixth sense for market tops through decades of observation. Markets don't just collapse without warning. They always tell a story first through divergences, leadership changes, and volume patterns. I made my fortune by learning to read the signals, while others relied on rumors and hope. Remember this: the market will show you its hand before it shows everyone else. Train yourself to see these signals, have the courage to act on them, and the discipline to manage risk. That's how I turned the 1907 panic into one of my greatest trading triumphs. Not through luck, through preparation, patience, and the courage to act when the evidence became clear. I am Jesse Livermore, and I made $100 million shorting the 1929 crash when everyone else lost everything. What I'm about to teach you isn't theory or hindsight. It's exactly how I saw the crash coming and positioned myself to profit while the world burned financially. My methods aren't complicated, but they require discipline few traders possess. When I predicted the 1929 crash, I wasn't guessing. I was reading the market's language. I had spent decades learning to interpret what the tape was telling me, not what newspapers or experts claimed. The market always tells the truth if you know how to listen. Let me show you exactly what I saw in 1929. First, I noticed divergence between the Dow Industrials and the railroads. Transportation stocks weren't confirming the broader market strength. This is critical. When the companies that move goods aren't thriving alongside the companies making those goods, something is fundamentally wrong. Second, I observed volume patterns changing dramatically. During rallies, volume was decreasing, a classic sign of exhaustion. Meanwhile, selling pressure came with increased volume. The market was speaking clearly to me. Smart money was distributing shares to unsophisticated buyers. Third, I tracked margin debt religiously. By mid-1929, average Americans were borrowing unprecedented sums to speculate in stocks. I knew from experience that when taxi drivers and shoeshine boys give stock tips, the end is near. The public is always wrong at extremes. I didn't act immediately, though. Timing is everything. I waited patiently for my signal. The market's first significant break followed by a failed rally attempt. When prices couldn't make new highs after a sharp decline in October, I committed heavily to short positions. The rest is history. My discipline saved me. I ignored the bullish headlines. I disregarded the youth's new era propaganda. I focused solely on price action and market behavior. This is the essence of successful speculation. Trade what is, not what should be. Many don't realize I had tried shorting earlier in 1929 and got stopped out. I lost money, but I kept my losses small and preserved capital for the real opportunity. This is crucial. Protect your capital at all costs. Without ammunition, you can't fire when the perfect target appears. I'm often asked how I maintain conviction while facing ridicule. Simple. I trusted my system, not my emotions or others' opinions. The market doesn't care what you think or feel. It rewards correct positioning, not good intentions. My approach in 1929 wasn't unique. I applied the same principles that had made me millions in the 1907 panic and other major market turns. I looked for divergences, volume patterns, extremes in sentiment, and technical breakdowns. These signals still work today because they reflect human nature, which never changes. Remember this. The biggest money in trading is made when a market moves from one condition to another, from bull to bear, or bear to bull. These transitions create the greatest dislocations and therefore the greatest opportunities. Most traders miss them because they're married to a permanent bullish or bearish bias. I made $100 million in 1929 not because I was permanently bearish, but because I recognized when conditions had fundamentally changed. That's the lesson I want you to take from my experience. Learn to recognize these transitions, position yourself accordingly, and have the courage to act decisively when others freeze. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. My 3-point confirmation system is what separated me from the amateurs who consistently lose their shirts in the market. I developed this system after years of painful losses, taught me that conviction without confirmation is just gambling. When I trade, I never enter a position until I see all 3 confirmation points align. First, I identify the primary market trend. Second, I wait for a pullback or consolidation within that trend. Third, I look for a specific trigger that signals the resumption of the primary trend. Only when all 3 align do I put my money on the line. Let me explain how I apply this in real markets. In 1907, before the panic, I observed the primary trend had turned bearish. The market was showing weakness in railroad stocks, which were the backbone of the economy at that time. I didn't rush in. I waited patiently as the market attempted a rally. This was my second point, the counter-trend move. When Union Pacific failed to make a new high and instead rolled over with increasing volume, I had my third confirmation. I went short with everything I had. That decision made me $3 million in a single day when the market collapsed. I've learned through bitter experience that patience is not just a virtue. It's a necessity. In 1929, I saw the same pattern forming. The primary trend had become dangerously overextended. My first point was confirmed. Then came a series of failed rallies. My second point, when the market couldn't push higher on good news, I had my third confirmation. I went short again and made $100 million when the crash came. But don't misunderstand me. This system isn't just for bear markets. In 1924, I observed the primary trend had turned bullish after a period of consolidation. That was my first point. When the market pulled back but held above previous support levels, I had my second confirmation. When buying resumed with expanding volume, I had my third point. I went long and rode that bull market for substantial gains. The beauty of my three-point confirmation system is its versatility. I've used it on stocks, commodities, and currencies. The market's language is universal. The key is in the execution and the discipline to wait for all 3 points. Many traders have asked me why 3 points, why not 2 or 4? I'll tell you what I've learned from my decades in the market. 1 point is just an observation. 2 points might be coincidence, but 3 points of confirmation establish a pattern with high probability. Remember, I don't try to catch the exact bottom or sell at the exact top. That's a fool's game. I wait for confirmation that the move is underway, then position myself in the direction of the primary trend. I'm content to capture the meat of the move while minimizing my risk. My system requires patience above all else. Most traders fail because they cannot wait. They feel compelled to be in the market at all times. I've spent weeks, sometimes months, completely out of the market, waiting for my 3 points to align. Those periods of inactivity have saved me millions and positioned me to strike when the time was right. Master my 3-point confirmation system, and you'll separate yourself from the crowd that consistently feeds their capital to the market. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. Today, I'm going to reveal one of my most powerful market insights, the volume divergence secret that helped me amass millions when others were going bankrupt. This isn't theoretical nonsense. This is the actual method I used to predict the 1929 crash and short the market to make $100 million when everyone else was jumping out of windows. Volume divergence is my personal market truth serum. I discovered early in my career that price can lie, but volume rarely does. When I see price moving in one direction, but volume telling a different story, I pay very close attention. This divergence is the market whispering its secrets to those of us who know how to listen. Let me explain exactly how I use this. When I see prices climbing to new highs but volume decreasing with each new high, I recognize this as distribution. Smart money quietly selling to the uninformed masses. I don't join the euphoric buyers. Instead, I prepare for the reversal. I made my first million using this exact principle in the cotton markets when I was just 28 years old. Conversely, when prices are plummeting to new lows, but volume is diminishing, I recognize accumulation, insiders quietly buying while spreading fear. This is precisely when I begin to build my positions. I remember applying this during the panic of 1907, buying stocks when blood was literally in the streets and watching my positions multiply several times over. My volume divergence method requires 3 specific components to work effectively. First, I always compare current volume to the average volume over the previous 10 periods. Second, I look for a minimum 15% divergence between price action and volume behavior to confirm a legitimate signal. Third, I wait for a price reversal to confirm my analysis before committing significant capital. I've learned through painful losses that timing is everything. I never rush to act on volume divergence alone. I wait for the market to confirm my suspicions with an actual price reversal. During the Northern Pacific corner of 1901, I ignored this rule and entered too early, costing me a substantial portion of my trading account. The most powerful application of my volume divergence method comes at market extremes. I made my greatest profits not from everyday fluctuations, but from major tops and bottoms where volume divergence was glaring. In 1929, I noticed decreasing volume on rallies for months before the crash, which convinced me to build my massive short position. My technique works across all time frames, but I've found it most reliable on weekly and monthly charts for major moves, and daily charts for shorter swings. I don't bother applying it to intraday charts. The noise-to-signal ratio is too high. Remember this. Markets are driven by human psychology, which never changes. The volume divergence secret worked for me a century ago, and it works today because fear and greed remain constant. Master this one pattern, and you'll see the market's true intentions before the masses do. That's not speculation. It's the distilled wisdom from my 50 years of trading the markets. I am Jesse Livermore, and I want to tell you about my pivotal point theory that allowed me to anticipate the 1929 crash and make $100 million, equivalent to $1.5 billion today. This wasn't luck. This was the culmination of decades studying market behavior and recognizing patterns that others simply couldn't see. My pivotal point theory identifies critical market turning points where the smart money shifts direction before the public realizes what's happening. I developed this theory through painful losses and methodical analysis of my trading journals. By September 1929, I could feel something wasn't right in the market's behavior. I noticed 3 critical signals that summer that told me disaster was imminent. First, the divergence between industrial stocks and railroad shares. Transportation wasn't confirming the broader market advance. When I see the companies that move goods not matching the enthusiasm of companies making goods, I know something fundamental is breaking down. Second, I observed the narrowing of market leadership. By August 1929, only a handful of stocks were pushing indexes higher, while the majority were already declining. I've always said the market isn't about the averages. It's about what's happening beneath the surface. The deteriorating market breadth was screaming danger to anyone willing to listen. Third, and most importantly, I detected what I call internal selling. Major players quietly distributing shares while publicly remaining bullish. I tracked specific price action at key support levels, noting how stocks bounced weakly on good news, but sold off sharply on minor negatives. This told me the big money was already heading for the exits. By September 1929, I had established my largest short position ever. When the initial break came in October, I didn't cover immediately. My pivotal point analysis told me this wasn't just a correction, but the beginning of something catastrophic. While others were buying the dip, I was adding to my shorts. The key to my pivotal point theory isn't just technical, it's psychological. I understand that markets move based on human emotion, not just economic data. When I see euphoria reaching extremes, with taxi drivers and shoeshine boys giving stock tips, I know we're approaching a pivotal turning point. I apply my theory through specific rules. First, I identify the primary trend using weekly and monthly charts. Second, I look for divergences between related sectors. Third, I watch volume patterns at key price levels. Fourth, I monitor sentiment indicators for extremes. When these align at a potential pivotal point, I position myself accordingly and substantially. My biggest lesson from 1929 was patience. I didn't try to pick the exact top. I built my position methodically as evidence accumulated. When others panicked during the crash, I remained calm because I had anticipated it. This emotional control is as important as the analytical framework. Remember this: markets always return to value eventually. The further they stretch from fundamental reality, the more violent the snapback. My pivotal point: theory isn't about predicting exact timing. It's about recognizing when conditions are ripe for a major reversal and positioning yourself accordingly. I've shared my method with you now. The patterns I spotted in 1929 have appeared many times since 1987, 2000, 2008. They'll appear again. The question is, will you recognize them when they do? I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. The market has been my greatest teacher and my greatest adversary. Today, I'm going to share with you what I consider the most valuable skill I've developed over my decades in the markets: reading market sentiment. When I first started trading, I believed charts and numbers told the whole story. I was wrong. The market is not a mathematical equation. It's a psychological battlefield. I learned this lesson the hard way, losing millions before I understood that sentiment drives price action more powerfully than any fundamental value. I developed my ability to read market sentiment through careful observation. I don't just watch price movements. I study the behavior behind them. When I see a stock rising on declining volume, I recognize exhaustion. When I see panic selling on massive volume followed by stabilization, I smell opportunity. These are the psychological footprints that have led me to my greatest trades. My method for reading sentiment begins with watching the market leaders. I pay particular attention to how these stocks react to news. When positive news fails to lift a previously strong stock, I know sentiment is shifting. I've made millions by being among the first to recognize these subtle changes that precede major market moves. I remember in 1907, during the banking crisis, I observed a peculiar pattern. Despite reassuring statements from financial institutions, certain bank stocks couldn't hold their rallies. The market was telling me something that contradicted the public narrative. I positioned myself short and made one of my first $1 million profits when the panic fully materialized. I've developed a sixth sense about crowd psychology in the markets. When I hear too many people expressing the same opinion with absolute certainty, I become skeptical. The crowd is usually wrong at major turning points. I've trained myself to feel comfortable being lonely in my market positions. In fact, I become concerned when too many people agree with me. One of my key principles is this: the market will show its hand before the news becomes public. I've noticed that stocks often begin declining before bad news is announced and rising before good news comes out. This isn't market manipulation or insider trading. It's the collective intelligence of the market gradually processing information that hasn't yet been crystallized into public knowledge. I don't fight the tape. When I sense the market sentiment shifting, I shift with it. Pride has no place in trading. I've learned to listen to the market rather than impose my will upon it. The times I've lost the most money were when I refused to acknowledge that market sentiment had changed. My greatest skill isn't picking tops and bottoms. It's recognizing when the psychological tide is turning. I watch for divergences between market sectors, changes in how stocks respond to news, and shifts in trading volume. These subtle clues have guided me through countless market cycles. Remember this: prices are never too high to begin buying or too low to begin selling. The key is to sense when sentiment is reaching extremes. I've made my largest profits by positioning myself against excessive optimism or pessimism, but only after the tide of sentiment has begun to turn. Timing this psychological shift, that's the true art of trading. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. My volume price divergence indicator isn't just another technical tool. It's the cornerstone of the strategy that allowed me to take 100 deals and turn it into $50 million, equivalent to over $800 million today. I developed this approach through decades of painful lessons and market observation. When I first started trading in the bucket shops of Boston in the 1890s, I noticed something peculiar about market movements. The price would often tell one story, while volume would whisper another entirely. I realized this divergence was the market tipping its hand. Let me explain exactly how my pivotal pattern works. I look for situations where price movement contradicts volume patterns. When prices rise on declining volume, I become suspicious. When prices fall on declining volume, I see opportunity. This simple observation has made me millions because most traders miss it entirely. The true power of my indicator reveals itself at market turning points. I call these pivotal points, moments when the market psychology shifts fundamentally. During the 1907 panic, I observed stock prices collapsing, while volume began tapering off. Most traders were paralyzed with fear, but I recognized this divergence as my signal. I bought heavily when others were desperate to sell, ultimately clearing $3,086 million in today's terms in a single week. I've refined this approach through multiple market cycles. The key is patience, waiting for the genuine divergence, not just any minor inconsistency. I look for sustained patterns where price continues in one direction while volume tells a contradictory story for at least 3 to 5 sessions. Anything less is noise, not signal. Consider my approach during the 1929 crash. I had been watching volume decline for months while prices continued their ascent. This classic divergence signaled weakness beneath the surface. I liquidated my positions and went short, ultimately profiting over $100 million in today's money when the market collapsed. My volume price divergence works because it reveals the truth behind market movements. Price can be manipulated, but volume represents the genuine commitment of capital. When these two elements diverge, smart money is making its move while the public remains oblivious. I implement this strategy with iron discipline. When I spot a divergence, I don't act immediately. I wait for confirmation, a price reversal that validates my observation. Only then do I commit significant capital, usually scaling into positions as the new trend establishes itself. The beauty of my approach is its universal application. I've used it in stocks, commodities, and currencies. The markets change, but human psychology, fear, greed, and herd behavior remains constant. This psychological consistency makes my volume price divergence indicator timeless. I've paid millions in tuition to the markets to develop this understanding. You need only listen to benefit from my costly education. When volume and price diverge significantly, pay attention. The market is speaking to you, revealing its future direction to those disciplined enough to listen. This isn't speculation. It's the foundation of how I built my fortune multiple times over. I am Jesse Livermore, the man who made $3 million in a single day during the 1907 market crash. What I'm about to teach you isn't theoretical. It's the exact blueprint I used to anticipate one of history's most devastating financial panics before it happened. My methods aren't magic. They're meticulous observation, translated into decisive action. The signs of the 1907 crash were visible months before the collapse for those who knew where to look. I developed a system of tracking what I call market tells, subtle indicators that reveal institutional weakness before the general public catches on. When I noticed Union Pacific stock struggling to make new highs despite positive news in early 1907, I knew something was fundamentally wrong. My first principle: watch what stocks do, not what people say about them. The newspapers were optimistic, but I observed key banking stocks like Knickerbocker Trust showing unusual weakness. I don't listen to opinions. I watch price action. When a stock should go up but doesn't, I pay attention. That divergence is the market telling you something. By March 1907, I had established my short positions. I wasn't guessing. I was responding to the market's own signals. I saw copper prices declining while mining companies reported business as usual. This contradiction was my second tell. I immediately shorted amalgamated copper and watched it drop from $115 to $38. My second principle: identify the weakest link in the financial chain. In 1907, it was the trust companies operating without sufficient reserves. I focused my shorts on financial institutions with the highest leverage and lowest cash reserves. Knickerbocker Trust was particularly vulnerable, and when it failed in October, the panic accelerated exactly as I had anticipated. I don't just look at individual stocks. I study the relationships between markets. Before the 1907 crash, I noticed call money rates rising dramatically while the market remained calm. This divergence was my third tell. When funding costs rise but stocks don't fall, someone is desperately supporting prices. That artificial support always breaks eventually. My third principle: concentration, not diversification, creates wealth. When I'm convinced of a market direction, I commit significant capital. During the 1907 panic, I concentrated my positions in the weakest sectors: banking, copper, and railroads. This focus multiplied my returns when the crash finally came. What separates my approach from others is patience. I established my short positions months before the actual panic. Most traders lack the discipline to wait for their thesis to play out. I sat with my positions through minor rallies, maintaining conviction in my analysis of the underlying weakness. The final tell came in August 1907 when several minor banks failed, but the market quickly rebounded. This false recovery convinced most investors the worst was over. I knew better. These small failures were tremors before the earthquake. Instead of covering my shorts, I added to them. When the full panic hit in October, I was perfectly positioned. I don't predict markets based on hunches or emotions. I read the market's own language: price action, volume patterns, sector rotation, and liquidity conditions. These signals told me clearly that 1907 would bring disaster, and I positioned myself accordingly. The $3 million I made that day wasn't luck. It was a reward for correctly interpreting what the market was already telling us. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. What I'm about to teach you about reading market sentiment isn't theory. It's what made me millions in the crash of 1907 and again in 1929. This psychological warfare is what separated me from the amateurs who were crushed when the market collapsed. The market is nothing but a reflection of human psychology, fear and greed manifested in price action. I learned this the hard way, losing everything multiple times before I understood that charts don't move markets. People do. And people are predictable when money is at stake. Here's exactly how I read market sentiment. I watch what the public does, then do the opposite. When taxi drivers and shoeshine boys start giving stock tips, as they did before the 1929 crash, I know the top is near. I don't need complex formulas. I need to understand human nature. My first principle: the market discounts everything except human emotion. News, earnings, economic data, all priced in before you hear about it. But fear and greed, those leave footprints I can track. When I see unusual volume without corresponding price movement, I pay attention. This tells me smart money is accumulating or distributing positions. In 1907, I noticed unusual selling pressure despite positive news. While others bought the dips, I shorted the market aggressively. The result? I walked away with $3 million when the panic hit, equivalent to about $86 million today. I don't follow the news. I follow the market's reaction to news. If bad news comes out and stocks barely drop, I know sentiment is bullish. If good news arrives and stocks sell off, sentiment is bearish. This divergence between news and price action is my signal. My second principle: silence speaks volumes. When a stock should move but doesn't, pay attention. In 1929, I noticed the market's tepid response to positive economic data. This lack of enthusiasm, this silence, told me the bull market was exhausted. I also study sector rotation. When money flows from speculative sectors to defensive ones like utilities and consumer staples, I know smart money is preparing for a downturn. I witnessed this before every major crash I've traded. My third principle: the public is always wrong at extremes. When everyone is bullish, I get bearish. When panic selling hits and headlines scream doom, I start buying. Not because I'm contrarian for its own sake, but because extremes in sentiment mark turning points. I developed a habit of keeping a trading journal not just of my trades, but of my emotions. When I feel the urge to chase a stock higher, I recognize that as a warning sign. If I'm feeling it, so are thousands of others, and they'll be the ones holding the bag. Remember, the market is designed to fool most people most of the time. The crowd gets slaughtered at tops and bottoms. I made my millions by understanding that sentiment shifts before prices do. I don't use fancy indicators. I watch what people do, not what they say. I observe volume, price action, and divergences. I track the behavior of market leaders. When they start to falter while the indices still look strong, I know distribution is happening. This psychological warfare isn't about fighting the market. It's about aligning yourself with the smart money while the public chases fantasies. Master this, and you'll see the market through my eyes. I am Jesse Livermore, and I executed what many consider the greatest trade of the 20th century during the 1929 market crash. While others lost everything, I walked away with $100 million, equivalent to over $1.5 billion today. I'll decode exactly how I saw what others missed and how you can apply my methodology to today's markets. My 1929 masterstroke wasn't luck. It was the culmination of decades studying market patterns and human psychology. I'd already made and lost several fortunes by then, and those painful lessons prepared me for the greatest opportunity of my life. In early 1929, I noticed something critical that others ignored. The market wasn't just rising, it was accelerating irrationally. When I saw blue-chip stocks trading at 30, 40 times earnings, I recognized the classic pattern of market euphoria. But I didn't act immediately. Patience was my weapon. I watched as newspapers proclaimed a new era of permanent prosperity. I observed ordinary people, taxi drivers, shoe shine boys, waiters, giving stock tips. This was my signal. When the public becomes wildly enthusiastic about stocks, I become deeply cautious. I've learned this lesson repeatedly throughout my career. When everyone believes markets only go up, the end is near. By September 1929, I had methodically built massive short positions. I wasn't guessing. I was following my trading rules with discipline. My first principle has always been, don't fight the tape, but don't follow the public either. The tape was showing distribution patterns, institutional selling, disguised by market strength. My second principle was position sizing. I didn't risk everything on one trade. I scaled into my positions over months, adding as my conviction grew. This methodical approach protected me from being wiped out if my timing was slightly off. When the crash began on October 24th, I remained calm while others panicked. I prepared mentally for this moment. As the Dow plummeted 11% that day, I didn't cover a single short. I knew from my years of experience that the first big down day is rarely the bottom. The following week, on Black Monday and Tuesday, the market collapsed completely. While most traders were frozen in fear or desperately selling at any price, I methodically covered my shorts at various levels. I never tried to sell at the exact top or buy at the exact bottom. I take the middle portion of moves where the risk-reward is optimal. My third principle, which saved me in 1929, was emotional control. I didn't gloat or celebrate as others lost everything. I knew markets are cyclical and success is temporary. I focus on executing my plan without emotion. The most important lesson from my 1929 trade wasn't the money I made. It was validating my lifetime of market study. I confirmed that markets operate on patterns that repeat because human nature never changes. Fear, greed, and herd mentality drive prices to extremes in both directions. If you want to apply my 1929 strategy to today's markets, remember this. The crowd is usually wrong at extremes. When everyone is absolutely certain about market direction, prepare for the opposite. Develop your own indicators of extreme sentiment. Mine were the taxi drivers giving stock tips. Yours might be different, but the principle remains the same. Most importantly, have the courage to stand alone when your analysis tells you the crowd is wrong. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. My tape reading techniques earned me over $100 million in today's dollars. And I did it without computers, without algorithms, just my eyes and my instincts reading the market's movements. When I started on Wall Street in the early 1900s, we had ticker tapes, physical paper showing price movements. I would sit for hours, watching how stocks behaved. I wasn't interested in news or tips. I was interested in what the market itself was telling me. Let me tell you how my tape reading techniques still apply to your modern markets. The technology has changed, but human psychology hasn't. First, I look for what I call pivotal points. Price levels where the stock has historically shown significant support or resistance. When a stock approaches these levels, I pay careful attention. If it breaks through with increasing volume, I know something important is happening. I made my greatest profits by watching stocks push through these pivotal points. In 1907, I made $3 million shorting the market during the panic because I saw the tape showing persistent selling pressure. The newspapers were still optimistic, but the tape never lies. I trusted what I saw, not what I heard. You have advantages I never had. Your charts can instantly show volume patterns, price movements across multiple time frames, and market breadth indicators. Use them. But remember, the core principle remains the same. Watch what the market is doing, not what people say it's doing. I learned painfully that market movements come in trends. The money isn't made in the minor fluctuations, but in the big swings. I lost fortunes by overtrading, by trying to catch every small move. Don't make my mistake. When you identify a major trend, ride it. I always said there's only one side to the stock market, not the bull side or bear side, but the right side. My second principle, confirm your readings with volume. Price movement without volume is suspect. I always look for increasing volume to confirm a breakout. In today's markets, you can use volume indicators instantaneously, a luxury I never had. Third, I watch market leaders. In my day, it was railroad stocks and industrials. Today, it might be technology or biotech. The behavior of these leaders often foretells the broader market's direction. When I saw Union Pacific weakening ahead of others in 1929, I knew something was wrong. My fourth principle, patience. The market will tell you when it's ready to move. I made my biggest mistakes forcing trades when the tape wasn't clear. Wait for confirmation. I often said, it was never my thinking that made the big money for me. It was always my sitting. Apply these principles to your modern charts. Look for pivotal points. Confirm with volume. Watch the leaders. And above all, be patient. Remember, markets have changed, but human nature, fear, greed, hope, and ignorance remains constant. The electronic ticker tape of today still reveals these emotions just as clearly as my paper tape did a century ago. This is my legacy. Use it wisely.